to It's the Economy. Global markets are reeling after US yields jumped overnight. The 10-year bond yield, which is, of course, the world's cost of capital, is at a new 16-year high of 4.95%. That was the high yesterday. While almost the entire yield curve from 1 month to 30-year is above 5%. While this is in response to strong retail sales data, the rising yields are also pulling down financial markets, especially equity markets all over the world, on fears that more funds will go to treasuries. And that's because the risk-free return is now over 5%. That's what they offer. That explains why all emerging markets today are lower. To give us more color on the impact of high US yields, I have with me perhaps the best in the business, Jahangir Aziz, the Global Head of Emerging Market Economics at JPMorgan. Jahangir, well, good evening to you, and I'm really grateful that you have stayed up so late for my show. Well, first up, what is the JPMorgan view of the yield curve itself? Does it go even higher than this 5% mark, or is it likely to remain at current level for a very long time?
So I think, the JPMorgan view is that, look, if you look at the fair value of the 10-year rate, this is clearly an overshooting of the fair value of the 10-year rate. So if you look at issuance, QT, where the Fed is supposed to be, one more rate hike maybe, but we have a baseline of no more rate hikes. And if you look at the demand for US Treasuries coming out of sovereign wealth funds, coming out of central banks, if you add them all together, then a close to the 5 is an overshooting of the 10-year, and that the 10-year should be coming down. But then, what we are not grappling with, which is the fact that, you've seen a significant increase in geopolitical tensions, and, we are already in the throes of, the Ukraine war continuing, and now we have another, geopolitical tension that has been rising in the Middle East, and there's a significant amount of uncertainty. And as you know, Latha, during times of uncertainty, people seek the safety of US. And so I think both the rise of the US Treasuries as well, the rise of the US dollars, as well as this, increase in the 10-year rate, sort of it reflects that degree of uncertainty. And, that's sort of the geopolitical front, but also I think on the economic front, if you've looked at the data flow coming out of the labor market, coming out of, September reading of retail sales, along with the manufacturing output, it looks as if, this economy has continued resilience, and that resilience will probably last for quite a bit longer than we had all anticipated.
No, that's true. But two questions here. If yields remain so long, is there a threat of financial accident, like the banks earlier? Or is there a greater likelihood of recession in the US a little later?
So even when the rates 10-year rate yield hadn't gone to 5%, right? When it was at the 4.25 level, I think the belief was that if these rates remain for a long period of time, then over a period of time, it's a long grind, but over a period of time, the effective lending rate, and the effective lending rate essentially is when things that had been refinanced, let's say 3 years ago, during the pandemic, all of that come due and will be refinanced at the higher rate. The effective lending rate for corporates will go up. Similarly, the effective lending rate for households will also go up. The maturity weighted mortgage rate hasn't really moved very much because a lot of people in the US still hold these 20, 30-year bonds, 20, 30-year mortgages. Now, but as these mature and as these get refinanced, there will be an increase in the cost of debt, and that would put pressure on both corporates and households. And there was a belief that even though the baseline remains a soft landing, the risk still remains that US could slip into a recession that would be much more delayed and perhaps perhaps deeper. So I think that risk scenario was there even when rates had not reached to 5%. I think at 5%, those risks simply become a little higher.
Okay. So stronger than expected growth in the near term, but probably deeper than expected recession in the medium and long term. Okay, now what the impact on emerging markets? Do you see any serious instability at all in any EMs?
So I think, most of the smaller countries, the frontier countries, as we call it, those countries clearly are in danger, right? They're in danger not only because they have a significant amount of external debt, some of them already are doing debt restructuring, and chances are that if you have external funding, not only at these high costs, remember these countries have to refinance their external loans, and if they finance the external loans at these rates, they will find it very difficult not to avoid debt restructuring. So assumption is that you will probably have more countries at the frontier level getting into trouble. But I think at the core of the emerging markets, so if you're looking at the Brazils, the Mexicos, the Indias, the Indonesias, South Africas, etc., external debt, private sector external debt has been very, very low coming into the crisis. So has private sector credit. So I don't think that there is this belief, there is this fear that because rates are kept at high at that level, you are going to get into a financial crisis. Clearly, finding new funding is going to be difficult. There is no doubt about it. But again, current account deficit countries, the current account deficits are very well contained. So you require a combination of, I would say, higher oil prices, continued high interest rates, and this is the part that is far more important, is that a continued strength in the US dollar. Most of the times, emerging markets go and get into trouble not because US rates are high, but because the dollar spikes and the dollar strengthens. And that's what really pushes FX depreciation. And that's when, financial instability arises. But right now, Latha, I would say that surprisingly, I'm not, and I knock wood at this point in time. Surprisingly, most of the core emerging market economies have reasonably strong fiscal position. They have reasonably strong monetary policy, and their current account is very well contained. And so I think, accidents can happen left at any point in time. And it's pointless my telling that accidents won't happen. But compared to let's say 2013 when the taper tantrum happened, things are very, very different. And among Asian central banks, there's a reasonably large amount of FX with which they can defend the currency. So I'm feeling reasonably comfortable that even if the rate remains this high, you're not going to see the kind of panic. You're not going to see the kind of financial crisis that we've seen in the past. But the smaller countries clearly are the ones where the concern is.
No, like you said, it's only when dollar strengthens that emerging markets have a problem. Now, dollar actually did strengthen with the yield, but it is becoming stable at around that 106.5, not even going to 107. So do you see it going higher? But the bigger question I have is the rupee has been amazingly stable, largely due to RBI intervention. What's your view? Do we see more weakening?
So I think those are two separate issues. I think the pressure on the rupee, like every other emerging market currency, will be downward, i.e. depreciating pressures. You really cannot fight dollar strength at the same time. When US cash is paying you risk-free 5.5%, it is very difficult to see capital flows coming into emerging markets, regardless of what their growth prospects are. We have seen this play out. So I think it is going to be difficult to find external funding. But I think that the pressure that is going to be exerted, and we've already seen this pressure play out for the last 6 weeks, 7 weeks, 8 weeks, and I think the central banks, in both RBI as well as the ones in Asia, have already been intervening in the FX market, and they are strengthening the interbank lending rates. They're tightening liquidity. That is effectively is higher interest rate, even though they're not using policy rates. So I think that by and large, a combination of liquidity management, liquidity tightness, along with FX intervention, is probably the way in which the RBI will go, just as the way in which most Asian central banks will go. Now, the other central banks are different stories because they don't use FX intervention as much, but that's a different story. But as far as RBI is concerned and most of the Asians are concerned, I think it's going to be a combination of liquidity tightening. So effectively, you're raising interbank rates and FX intervention. And I think that's the way at least the first line of defense will be.
Oh, yes. Actually, we're all waiting. When will that promised OMO or threatened OMO sale of bonds will come from the Reserve Bank? But yields are high today. I mean, the highest I've seen in many months, the Indian yields. Now, let me come to the growth story. The US macro data may be very strong if you look at the retail sales, but a slowdown is clearly hitting India. 3 IT companies announced numbers, Infi, TCS and HCL Tech. Between them, the headcount has come down by 17,000 jobs. Infi even said that it won't even go to the campuses this year. So, will India slow regardless of strong US macro data?
So I think, we've spoken about this, Latha, before when we talked about, the prospects for India for this year. And our view then and the view right now is the same. That look, the global economy is going to slow. US economy will be slowing. The rest of the world will be slowing. Europe has already slowed down significantly. There's some stabilization taking place in China, but not very much. China will probably get about 5.2% growth rate this year. And in this slowing global economy, the big driver of India, the 2 big drivers in India, which was one was public investment, the other was services export. Services export will slow down, and we did expect the second half of the fiscal year where growth would slow down. Now, the question is the slowdown going to be materially different from the part that we had? Right now, I don't think so. I think that, as we just spoke about, that the US is still showing significant amount of resilience. Emerging market ex-China is showing the same kind of resilience. And China is stabilizing and picking up. So I think that, we still have the view, which we had in the past, which is second half of the year, the Indian economy would slow down and exports would slow down, and we maintain that view. I don't think we have changed our growth trajectory just because the 10-year rate is at 5%, or that the U.S. economy is going to slow down. I don't think the slowdown is the slowdown that we now have for the U.S. economy isn't more deeper than what we had in the past. In fact, if anything, the shallower than the past. We've just upgraded our third quarter GDP forecast to 4.3%. So again, I know that this sounds very strange, but I think that things will slow down, but I don't think we are headed for any kind of a calamitous outcome. Obviously, these could be famous last words, and particularly if geopolitical risk flares up, and in that case, obviously all bets are off.
Yeah, I have to get one question in on crude, as you spoke about geopolitics. What's your JPM's base case? $90, $95, or does it go to triple digits?
No, of course, we have a base case which is based on, fundamental drivers of oil, which is drivers of demand and supply. And based on that, which we had a view, by the way, since May, the exit for 2023 was about $85, $86, and an average close to about, just below 90 for the fourth quarter. We still have that view. I think what has happened, obviously, is that there is a risk premium that has been added to the oil prices. The risk premium has taken oil prices above 90. Again, it's very difficult to say in this kind of very, geopolitics which is in a flux, where can oil go? But on fundamentals, if you take away the geopolitical risk premium, oil prices, it's very difficult to see oil prices breach $85, $86 in the fourth quarter, and also in 2024, they're likely to remain very range bound in the mid 80s. You need to something like a geopolitical risk or significant supply cuts by, let's say, OPEC Plus, which is not in our baseline. You need something like that to deliver a price which is sustained above 95 or towards 100.
To our ears, if you say 85, Jahangir, and on that note, deeply grateful that you have stayed up for us and spoken to us about US yields and the impact. Have to wrap up on Bazaar. We've already overshot time. Chartbusters up next.